Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this video, we'll continue exploring the warning signs of overbuilt luxury real estate markets and how smart investors can find safer opportunities. The second home slowdown, mountain and desert escapes. When a luxury market relies heavily on vacation purchases, it's inherently unstable. Expensive mountain resorts and exclusive desert retreats thrive during economic booms but suffer immediately when budgets tighten. Vacation properties are discretionary purchases. They're the first things people stop buying when the economy worries them. This creates a scenario where listing times stretch far longer and price cuts become deeper than in primary residential markets. You might find a beautiful, expensive cabin, but its resale success hinges on a robust national economy, something we can't guarantee. Investors often find their money tied up indefinitely here because the urgency to buy simply doesn't exist for most people. High-end hotspots that grew too fast, post-pandemic boom correction. The period between 2021 and 2023 saw astonishing price growth in many smaller metro areas or wealthy suburban pockets around major cities. Driven by remote work and the desire for more space, luxury homes in these areas jumped in value, sometimes by 50% or more. This rapid, intense growth encouraged further development. Now, as that post-pandemic momentum slows, these markets are prone to sharp and painful price corrections. If a home price only reflects the temporary fervor of a buying frenzy, that valuation isn't stable. Luxury goods in these transitional zones are experiencing greater supply now, just as buyer migration slows. This combination means prices will likely come down to meet sustainable long-term value, punishing investors who bought at the peak of the enthusiasm. The financial pain. Why overbuilt markets are bad for your wallet. Investing in an overbuilt luxury market doesn't just mean your property sits unsold. It introduces specific financial risks that can immediately drain cash flow and freeze your capital. These are the practical realities of high-end oversupply. Low rental income versus high running costs, WA fees. One common mistake investors make is assuming high-priced homes automatically generate profitable rental income. For luxury condos, the monthly costs alone can easily exceed any reasonable, potential rent. Luxury properties come with substantial monthly fees, including homeowners association fees, property taxes, and insurance. If the rent you can achieve doesn't significantly surpass these huge monthly outlay costs, you are running at a negative, losing money every month just to hold the property. This negative cash flow turns a supposed investment asset into a frustrating liability. Cost component. Typical annual burden, example. Impact on cash flow. WA, maintenance. $15,000, $30,000. Drastically reduces rental profit. Property taxes. $12,000, $25,000. Fixed annual expense regardless of occupancy. Potential rental income. $30,000, $45,000. Often barely covers operating costs in oversupplied areas. Your money is frozen, the problem with illiquidity. Liquidity refers to how quickly you can convert an asset into cash without losing significant value. Luxury real estate is often inherently less liquid than standard single-family homes, but oversupply makes the situation worse. In a slow, saturated market, selling the property quickly is impossible. If you invest $3 million in a high-end condo and the market stalls, that capital is essentially frozen. If you needed that money back for an emergency, to seize another opportunity, or for retirement, you might have to wait years, or significantly drop the price, taking a huge loss, just to find a buyer. The lack of available buyers in an overbuilt market means your investment capital is temporarily held hostage, limiting your financial flexibility. Luxury real estate gets hit harder in downturns. When economic trouble starts, people adjust their spending habits. Non-essential, status-driven purchases are the first items to be cut from the budget. A seven-figure second home is the definition of a non-essential purchase. During broader market uncertainty, the mid-range and affordable housing markets might soften slightly, but the top-end luxury sector often sees the most pronounced and dramatic drops in both volume and price. This extreme volatility means that once the market turns against you, the losses can be greater and harder to recover than they would be in a stable, essential housing market. Investors must appreciate that the high ceiling of luxury returns comes with an equally high risk floor during economic uncertainty. The goal of buying in this video should be stability and reliable yield, making overbuilt luxury markets unnecessary risks. Focusing on sustainable growth. Navigating the real estate market requires caution, especially in the high-end sector. Identifying and avoiding overbuilt luxury markets is essential for protecting capital and ensuring a profitable investment timeline. The key warnings are clear: excessive inventory, constant price reductions, and too much concurrent construction. These signs indicate a market that cannot absorb the supply, guaranteeing poor performance for new investors. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.